Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CFO, Brad Farquhar from SSC Security Services. SSC Security trades on the TSX Venture Exchange under the symbol SECU and on the OTC under SECUF. The company is currently trading at $2.76 with roughly 20 million shares outstanding, or about a $55 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Good to have Brad with us today. Brad, welcome.
Thank you. Good to be here.
Trevor and I are a little familiar with the company because we've had a chat in the past, but I know a lot of our listeners and our subscribers are very new to the story. So I'm happy you can sort of come and tell us the story. And I'm just going to hand it over to you and let you tell us all about the business.
Sure. Thanks a lot, Trevor and Paul. And it's good to be here. Hi, everybody. And just want to tell you a little bit about our company. You may have, I'll give you a little background as I go through. This is a presentation deck, by the way, that is on our website. It's our most recent quarterly presentation deck and covers the facts and numbers as they were reported for the quarter ended December 31. We are in the getting ready to report the next quarter ended March. And so that'll come out in the next few weeks, and you can watch our website for that. We try to update this presentation quarterly once the new numbers come out. But there are some corporate developments that are public, and I can talk about those as well within some constraints. But we have some M&A activity that's underway, and a transaction that we've announced and that's been press released. So let me just walk you through the deck a little bit, and I may go down a rabbit trail or two to add some color, and then glad to get into conversation. So we have lawyers, like most companies, and I'll move on to the next slide. So we are a public holding company that actively acquires and grows physical and cybersecurity companies in Canada. And we were founded originally in 2012 as a totally different company. We were called Input Capital, traded on the venture since 2012, and we were in the agriculture finance business. For a variety of reasons, we've stepped out of that business and are winding it up and making really good progress in that respect. But as a result of that wind up, we will end up with about $60 million of assets to be redeployed into this security consolidation strategy, which is really what we're running at Security Services Corp. Our founders have been in the security business since 1988 in various forms, built and sold at least once, and I can give you more color on that as we go along. But our strategy now is to grow into a $200 to $300 million revenue business over the next 3 to 5 years in the security industry in Canada. At that size, we should be generating $15 to $25 million in EBITDA, and we have a very conservative view of debt. And with interest rates going up, that's probably a good thing. We like to sleep at night, and security is a low margin, high volume business where if you have a bump in the road, it can affect you significantly, and you don't have extensive margins to cover mistakes. So we prefer to run with low to no debt. I'll carry on. So this strategy began to emerge in November of 2020 when we decided to make this pivot into security, and we closed the acquisition of SRG Security Resource Group of Regina in February of 2021. That was a $19 million transaction and came with about 400 plus employees. And that was our CEO, Doug Emsley, and his business partner, Blair Ross, were the founders of that company. So it was a bit of a related party transaction. We have some excellent board members who helped guide us through a bit of a complicated transaction because of the related party nature. And so for the last year and a bit, SRG has been part of our family and really is the building block and the platform from which we plan to expand. In the summer last year, we acquired the regional operations of Impact Security Group. Impact is based in Winnipeg. We acquired their Saskatchewan operations with about 215 employees for 1.35 million. Now, here's the announcement here that we made in February to acquire Avanti Logics Inc., which is Pubco, traded on the venture also under the symbol XX, back in February. This deal has changed, and we announced a few weeks ago now that we will not be acquiring all of Avanti Logics. We will be acquiring their Logics Security sub. And that's where about, of those 1,600 employees that were part of the entire company, about 1,400 work at Logics Security, and we will not be acquiring the Avanti Security brand, which is a little bit of a different business, excuse me, that does high net worth residential security. So that's the part we're not buying. We will be buying the part that is most familiar to us, which is a physical security business, guards across the country with large accounts in the corporate sector. So corporate security, so that's guards on site, doing electronic security installations for large companies. So that's cameras, monitoring equipment, pass keys, and all that kind of security hardware. And where the company does design and install and is a reseller of the equipment. And then SRG has a significant cybersecurity business that will also continue to be part of our picture going forward. So by the end of May, roughly, we will be a 2,400 employee security company with guards across the country from coast to coast, and also providing cyber and electronic security services. Here's our growth strategy. I won't dare to try and read all this to you, but SRG has been growing for, it's the sort of platform business that's been growing at about 6.1% quarter over quarter over the last little bit. So best, or in good shape and growing nicely. Best capitalized security company because of this balance sheet that's coming from as our legacy agriculture business runs off. There's probably about a year to go on that runoff, but most of that 60 million has now turned into cash, and the rest are simply first mortgages on farmland primarily in Saskatchewan, which as those mortgages mature will convert to cash and drop onto our balance sheet as cash. And you can see that on our balance sheet today in the mortgage line and some legacy assets. So that runoff is coming together quite well and far more quickly than we expected. I talked a bit about some of this other stuff, so I'm going to move on. Security segment is growing nicely. Of course, we had some partial quarters in the oldest quarters here, so the chart seems a little bit steeper than it normally would be. But I mentioned SRG has been growing at about 6% per quarter on the top line. We're at a point now with the agriculture business materially not being operational that 98% of our revenue is now from security. So we've really completed this pivot out of that legacy business and into the security business, with just some asset conversion that needs to take place from either assets held for sale or mortgages that need to turn to cash. Here's a little bit about our balance sheet and financial position. Significant resources available for acquisitions, and our plan is to grow organically and through M&A activity in the security space. You can see our debt outstanding. That chart shows it almost to zero, and then on Valentine's Day, we paid off all of our debt and we operate debt-free today. And we don't have any significant plans to add debt to the balance sheet as part of our permanent capital structure. We may use acquisition debt from time to time to close a deal or finance a bit of receivables as necessary from time to time. But we prefer to be liquid and pay cash and not factor our receivables, which is something you sometimes see in this industry. With those lower margins, factoring can eat away at that pretty quickly. We have a September year end, so Q1 is December 31. As of December 31, we had more than 40% of our market cap in cash, and that number has continued to rise as our cash has continued to grow. We're a dividend paying company. We've paid a dividend for about 5 years now. It's always been the same level. We did a share consolidation last year, so adjusted for the share consolidation, we pay 3 cents per share per quarter, and have been paying a dividend at that level for a number of years. Many of our shareholders are fans of the dividend strategy and have stuck around. They're sort of being paid to wait, and they've been patient with this pivot from one industry to another. Just the legacy business, as I said, it's winding up rapidly. You can see we've gone from almost $100 million in assets in that business to under 20, and that number has continued to shrink in the quarter. And we'll publish some new numbers on that in a few weeks. And as you can see from the chart on the right, most of that is mortgages. There are some collection accounts where we've made some good progress, and where any of that carrying value shown is secured against farmland. And so hard real asset, it's been going up in price every year. So actually our security continues to get stronger, and the potential for collections are collecting a greater amount than expected goes up every year as the land goes up in value. Really simple. We're going to buy security companies that are good and solid. We will use seller financing where possible, and we have a few deals in our pipeline that look like that. And our target is to get 10% EBITDA margins. If you know the guard business, that is high. EBITDA margins are typically 5 and 6, with Securitas, which is the largest in the world, based in Sweden, has 3 to 5% EBITDA margins. They make it up on serious volume at 250,000 employees. Our goal is to get it. Traditionally, we've had about a 6 to 8% EBITDA margin in SRG, and with a few of these higher margin add-on parts to the security business through our cybersecurity division and with electronic security, we hope to average our EBITDA margins up as close as we can get to 10%, although 10% is a bit of a stretch goal. And then we plan to grow organically by winning new contracts, which we do regularly, and then cross-selling our cyber services into our corporate clients. This acquisition of Logix will quadruple the size of our business, and both at the top line and the bottom line, and provide a whole new set of clients to cross-sell our cyber services to. And if you've been paying any attention to the news lately, you know that cyber is a hot topic. If you talk to insurance companies, it's a huge topic, and actually getting harder and harder to get insurance without having a very proactive cyber program in your company. So this is a boardroom conversation in many companies, and a real risk that we can help manage with our team of cyber consultants. So what we do in cyber is we can go in and analyze a company's current state, through penetration testing and sort of white hat hacking, trying to break into their systems, show them where they're vulnerable, and then prescribe solutions which can run the gamut from software solutions to 24/7 network monitoring that we offer for larger enterprises, monitoring their networks. And it's incredible, even with just the clients that we have, the billions and billions of attempts that are made on their networks every month. And we monitor those and have a team that can respond. And then if there is some kind of a breach, very quickly come in and plug the holes and help a company get back operating and back on its feet, deal with ransomware attacks and so on. So that's an interesting growth business for us. And then, when our shares are undervalued, we're willing to buy back shares. In the last 5 years, we've bought back over 35% of the company. And in fact, we did a substantial issuer bid right during the first part of the hard COVID lockdowns, and bought back a good chunk of the company at something like 60% of book value. And so Insiders now own about 35% of the company, between those of us who are, helped start it, and our board and our staff. And every payday, all of our staff are buyers of our stock. So by payroll deduction. So we're deep believers in eating our own cooking, and all the sort of cliches you could use. We are founders, and we operate the company like owners, not like managers. And I think you just take a different approach to business when you do. And so our goal is to grow our adjusted EBITDA by 10 to 15% a year through a combination of these strategies on a per share basis. And that's an important part, because if we are shrinking the denominator, obviously that helps contribute to driving a value to shareholders. Here's our management team. So Doug Emsley and Blair Ross are really the founders of the security part of our business. Doug and I have been partners in the agriculture business prior for the last number of years, and previously built the largest farmland fund in Canada that we sold to the Canada Pension Plan almost 8 years ago now. And Gordon Eastman is one of our agriculture partners, and is helping us with the runoff of our agriculture business. We have a pretty blue chip board for a small TSX.V company. It includes David Laley, who's the former chairman of Deloitte in Canada, and was a member of the board of the Bank of Canada. Mr. Hepworth, who used to be the finance minister and agriculture minister here in Saskatchewan. And David Brown, the former chairman of the Ontario Securities Commission, who's an M&A lawyer from Toronto. And so a good group of directors here, besides myself, and I just get to learn from some great guys, and it's a good team. And this is the same board we've had since we went public in 2012. Little just summary of the company. There you can see, we own, I think it's actually 35.9% of the company today. And these numbers are a little bit dated because the presentation is a bit dated. But looking at the shareholder list here, you can see not a lot of institutional money playing in this name yet. Primarily sort of a high net worth retail base of investors, and I guess not high net worth retail as well. We have about 2,000 shareholders altogether. But as you can see here, 60% of the shares are held by 15 people. A few of these are groups rather than people, but gives you a sense of the ownership of the company. And Winnipeg Airport Authority there is one of our largest clients. We do security for them on their property, on the entire property in Winnipeg. We don't do passenger screening, but all the other security required at an airport. And we do that at the Winnipeg Airport Authority. That came about by us acquiring, SRG acquiring they had a security company within the airport, and SRG acquired them about 10 years ago. And WAA has continued to get the service they expected, but has also made a bunch of money from dividends and the growth in their shares over the years, and it's worked out really, really well for them. So that's that model that we might replicate further. Not much to say here. Yeah, I'd rather get into conversation with you guys, but the security industry is large and stable. If there's any message at all, it's large, stable, but fragmented. There's lots of mom and pop operations that are primed for consolidation. And with our team that's been in the business for a long time, we know a lot of those players. The thing about mom and pop operations is often there's no succession plan, and they're trying to figure out how to retire and exit from the business at some point, and we come along and we can pay cash, and that makes us a good potential partner. We like them to stay in place for a few years during the transition, because it's a relationship business with clients, and the handoff of that relationship is really important. And then cross-selling cyber is an important part of our strategy. Cyber is much higher margin than the guard business, and is a real growth area these days. So when you put the two together with low to no long-term debt, we think we can grow and just be in a way a boring story that can just grow consistently, pay a dividend, and everyone can sleep at night knowing that their investment isn't going away. And that's our objective. So with that, maybe I'll stop, and Paul and Trevor, you guys can ask questions, and I assume maybe you let some of your audience ask questions too, right? You tell me.
Absolutely. At this point, let's remind everybody that's listening, if you do have a question that you'd like me to ask Brad, just use the chat function. And I see a few of you have already started, but yeah, feel free to ask any questions and I'll do my best to ask. Brad, why don't we just jump into one of my questions right off the bat is right now, you mentioned some of the areas you're in, but geographically, where do you guys really sell your services?
Yeah, good question. Sorry about my phone. It's going to go away.
No worries.
Funny, I thought, I put my phone number on the screen and the phone rang right away, but it's not that. Yeah, we are Ontario to BC is our current operation, but it's heavily weighted to Manitoba, Saskatchewan. So we are the we're the dominant player in Saskatchewan in the security business, especially since that Impact acquisition last summer. And then we have a pretty significant operation in Manitoba, primarily in Winnipeg. And then our cyber team is spread across the country from Vancouver Island to Newfoundland. And then we have we do some guard work and cyber work in the Greater Toronto area and Vancouver in particular. Not much in Alberta, just a few clients. And so with this Logix transaction, they are heavily concentrated in Ontario, the GTA, Montreal, and Vancouver. And so that's a nice fit with our kind of prairie footprint to be a national firm. And then them bringing their electronic security business and us bringing our cyber business create some really good cross-selling opportunities into our guard clients. The Logix also has some operations on the East Coast. They have a few people in some operations in Nova Scotia, Newfoundland, and New Brunswick. Also, I guess I mentioned Montreal. So it will be a truly national firm touching both oceans and with a nice breadth of service.
And, I assume you've got a pipeline of potential acquisition targets, or at least a list that you're going after. Geographically, is there anywhere that you sort of want to fill holes in, or how do we look at what kind of pipeline, or what the pipeline looks like?
Well, we have a decent pipeline especially from Doug and Blair's relationships in the industry, from a lot of time in it. Also, Logix brings with it a pipeline of deals that they've kind of had in their back pocket, relationships they've been building, and so we'll get more into looking into those and building those relationships ourselves. Geographically, I think there are opportunities in Alberta where we both have some operations, but it's not of significant size, and of course Ontario is huge, and most of the business that Logix does would be sort of London, Toronto, Ottawa, and I think there are lots of opportunities outside of those large centers where you still got a significant, you've got Southwestern Ontario, it's got lots of industries that have security needs, and some of the national clients that offer an opportunity to get into some of those areas. But then there's just a lot of fragmentation within every market, and I think there are good opportunities. And what we like about markets where we already operate and where we kind of do an acquisition is that we probably get a little bit more in terms of synergy at the management level when we bolt them on to the side of our operation. And so you don't need duplicate managers, and so you can find some synergies there and some savings. And that's what we're finding with this Impact acquisition here in Saskatchewan. We added 200 people, but there was a bit of a layer there where we were able to find some synergies. And of course, anytime you can do that, it drops to the bottom line, and that's all part of the story.
And you mentioned, you guys are sort of heavy on the guard side, and you guys do a lot of cybersecurity. Is there any other sort of pieces of security, or any other technology, or just any other sort of part of the industry you want to start looking at?
I think there are probably more opportunities for electronic monitoring. So this would be like home monitoring, but not residential. We don't really have any intentions to go into residential. That's a big player business now. It's really been consolidated into a few names, telcos and so on who've gotten into that business. But we do see lots of opportunities for electronic monitoring corporately. So that's cameras on site, whether it's in an industrial facility or even on construction sites. Here in Saskatchewan, there's a bit of a boom going on, just right here in Regina, where we're based. There are a very significant number of large industrial construction projects going on, where there are the construction phase is a more active security phase because you need, there's a lot more coming and going, and you need site supervision 24/7 because there's a lot of materials on site and equipment. And so those are opportunities to get the foot in the door, and then usually you can win the contract for ongoing security of whatever that facility is on an ongoing basis going forward. And so we see lots of opportunities in this pickup in the resource sector across Western Canada in particular, whether that's mine development, or here in Regina, it's all about canola crush plants that are being built, value added in agriculture and oil and gas expansion and monitoring, even on well sites. We do some monitoring for some pipeline companies, and who knows if more pipelines will get built. That's a longer story in this country, but definitely we definitely see a pickup in the resource sector as being an opportunity, but also a bit of a challenge. Here in Saskatchewan, that we compete sometimes for workers with the resource sector, and so that's created some challenges in recruitment and retention, and of course with inflation kicking in, that creates some wage pressure as well. But all the companies that we deal with are seeing it in their own businesses, so it's not a terrible time to go to them and talk to them about rate increases and being able to pass some of that on to employees for retention and to maintain quality of service. And so we've seen some good success in those areas.
Great. Let's talk about the sort of the metrics you really look to acquire at, and maybe we can talk a little bit more about Logix. But what's sort of the price you pay, and what kind of range do you want to keep it in?
Yeah. I'll probably be a little bit fuzzy on this for competitive reasons.
Sure.
But typically we see private companies in this space often changing hands for 4 to 6 times EBITDA. We'd probably start to get uncomfortable above those levels. The transaction with Logix is pretty competitive with those numbers. Actually, we're really quite pleased with that transaction and the way that's worked out. But what we ultimately see is an opportunity to do some acquisitions in that range, hopefully, and create a nice, stable, growing story that can get a premium valuation in the public market. And when you look at one company that I look at is GDI Integrated Services. They do, they're not in the security business, but their workforce and the kind of service they provide isn't really that dissimilar. Janitorial for commercial clients and a bunch of add-on services for building managers and so on. Not a dissimilar profile of average wage, margins, and those sorts of things. And they've run a very successful consolidation program in their industry, and trade at a pretty nice premium, up well above 10 times. And so if you can buy it at a low multiple and trade at a higher multiple, it gives you lots of currency to go out and just continue doing that and be accretive in every deal that you do.
Absolutely. How has COVID affected your industry?
Mm-hmm. It's been positive and negative. We've done a lot of extra work because of COVID, doing checking COVID passes at entry to city facilities and those kinds of things. But COVID slowed down some companies' plans for expansion, and with fewer people coming and going from offices, maybe there was a bit less demand for security at the front desk and some of those sorts of things. On balance, I guess I mentioned the Winnipeg Airport Authority as a significant client. Obviously, the airline industry was affected significantly, and we definitely saw a decline in billable hours within our airport business during COVID. But we see that coming back significantly now as air travel picks up. So, we had a bit of a lull in some industries and a bit more demand in other industries. And on balance, we didn't feel too affected by it. And that'll vary, of course, from security company to security company. But, our clients tend to be governments and, sort of public sector clients, industrial clients. And of course, industry didn't really have an option to slow down. People didn't go to the office, but the refinery here still ran and needed to, and those sorts of things. So in that respect, it's people know they need security and they can't live without it, especially when you're a big company that has risk if you're not providing that to your facility.
Now, you sort of touched on what I'm about to ask you earlier, as far as sort of employees and some of the issues that some of your customers are dealing with. What's it like trying to recruit or keep employees right now for your business?
It varies regionally. It's been more of a challenge in Saskatchewan because the resource sector here is picking up so significantly compared to other provinces. Really, our guys would say no problems with recruitment and retention in any province except Saskatchewan right now. And in Saskatchewan, it's really one of the keys in this business is to make sure you have a large enough complement of guards so that, if somebody gets sick or can't come to work, let alone the turnover part, but if they just get sick and can't come to work, you've got to put somebody else on it. And if that person has already worked their full number of hours that week, now you're paying overtime rates. And some of that can't be passed on to clients. So unbillable overtime is something that everyone in this industry is watching out for like a hawk, because it comes straight off the bottom line in order to provide the service that clients expect. And so our numbers are a little higher than we'd like on that front here in Saskatchewan, kind of fine in the rest of the country. And as we are able to get some some rate increases with clients and pass that on to employees, that's significantly helped with the retention side of things. And now that pretty much everyone seems to have had COVID, we're not having absenteeism as a result of illness so much.
And Brad, what other challenges does a business like yours face?
In any business, getting paid on time is important. And, that's one of the challenges that some of the mom and pop companies face if they have a more significant client and the receivable goes bad. That can turn that company upside down pretty quickly. We manage that by only taking on good clients who are good payers. And we've occasionally fired a few clients who, aren't good payers. And it's remarkable, actually, if suddenly you tell the guards not to show up on Friday because the client hasn't paid, it's amazing usually how quickly the check shows up and the guards are back on site. So, that's a constant tension in the business. And so managing working capital is important. Some companies, especially bigger companies, are on 60 or 90 day payment terms, but you have to fund payroll for those 90 days and keep your staff paid, or they aren't going to stick around very long. So that's very important. And so managing working capital and having a strong balance sheet are important to success in this business, and to ride out little bumps in the road that come along when a receivable is slow or someone's a slow payer for whatever reason. And that creates the opportunity too, sometimes with these smaller undercapitalized businesses, to step in as a well-capitalized company and make it, set the thing up on a solid foundation for the future.
And one question I didn't ask you, I should have, but do you bother looking south for acquisitions, or are you guys going to stick above the 49th parallel?
Yeah, there's that part of Southern Ontario below the 49th where we probably might look. But, for now, it's sticking to Canada is our strategy. The security is a little different in the US. There's a lot more guns,
Right,
and
true, yeah.
and our guards aren't armed. That creates a whole other layer of liability and risk that, and just litigation that happens in the US that, we'd want to finish building out our strategy in this market before looking to the US. And given some of those risks that I mentioned, it might be better to even look at other countries rather than the US, although the US has got proximity in its favor, but there might be other opportunities in, I don't know, in Western Europe that might have less of those risks attached to them.
Fair enough. Listen, let's jump on some of the questions that we've gotten from some of our listeners here, and it looks like a few of them are related to the cyber side of your business. And the first question is, how do you keep up with all the new cyber attack techniques?
Well, we have a team of 60 to 70 specialists in this area, and they're the guys who keep up on it. I mean, that's not an area of my expertise. I'm a finance guy, and I'm a decent computer user, but my eyes start to glaze over when I talk to these guys about some of some of it's kind of exciting, but crazy what can happen. And it actually wakes a guy up to the risks that you face just walking around with a phone in your pocket these days. But that's part of their job, is to keep up on all the latest. And we are industry partners with bigger companies like McAfee and Microsoft and others who have thousands of people working in these areas all the time. And so our job is to help clients implement best practices and try and stay ahead of the bad actors. And so bad actors are out there, and whoever you are, they've probably tried hacking your system at some point, and maybe they already have and you don't know it yet. And that's often what we find with some of this penetration testing is some of these systems are easy to get into, and it shows up that it's obvious that the bad actors have been there and they're lurking in the background just waiting for the right opportunity. And so that's just an area our guys they have a mandate to stay up to date, and sometimes we have to hire additional specialists in other areas that where we might not have the bench strength. But our goal is to try and have the best possible bench strength, and as a result, what often will happen is there are firms out there that market their cyber services. Some of the big accounting firms are getting into this and so on. Well, the people actually doing that work are often people like us, because they don't often have the bench they need to deliver the service that they're selling, and they turn around to subcontractors like us to do the actual work. And so that area is an interesting growth area for us to continue building out those kind of strategic partnership relationships to basically white label our service into their clients.
I'm trying to sort of think through that a little bit more. Clearly you're trying to prevent attacks. You're trying to sort of build the wall to prevent these hackers to get in. What happens when they do get in? Like, is this, if you had a breach, if you had something where something's gone wrong, what do you do at that point? Is there compensation that goes back? Is there some form of insurance? Is there, what do you do once they kind of get in there?
Sure. Well, we have a critical incident response team whose task it is to respond to those instantly. We got a call in the afternoon of Christmas Day, this past Christmas, with a significant client that had been ransomware attacked and needed to get back operating. And so our guys were there by within 2 hours and shut the system down and worked to get it back and running. And so that's the key. First thing is rapid response, and then your question kind of hinted at maybe a little bit of what risks do we face if we're already in charge and the system gets hacked. That's dealt with in our contracts. That we can. There's no 100% unhackable system unless you unplug the computer from the internet and maybe turn it off. I mean, that might be a safe system, but it's not much use. And so that's important in our contracting to ensure that clients understand that we're there to help them first of all maximize their defenses and then recover from any problems that might occur and provide this 24/7 monitoring of networks. I think is probably one of the next big things in corporate networks. Some companies do that internally, but there are a lot of companies that aren't big enough to support an IT department like that, and that's where we come in. And we'll put people onto a site where it's as if they work there, but they're a contractor who work for us and run the cyber security for that company. But coming back to the contract, we don't take. It's very clear in our contracts that we aren't liable for hacks that occur except for gross negligence. And just because it's a shifting playing field, there's always new attack vectors, and we will do our best to stay up on those and help a company stay in the 98th percentile of compared to their peers. But nothing is invulnerable these days.
And Brad, is this a business that has an exit in the future? Is this something? I mean, do you guys build this to sell it? What do you do? I
mean, our view is that anything is for sale for the right price, and this happened before. So a little history. So Doug and Blair founded Vision Security in 1988 and built it up to be about 1,000 employees, mostly in Western Canada, and they had somehow they came in contact with Securitas, and Securitas, as I mentioned, largest in the world, based in Sweden, somewhere between 250,000 and 300,000 employees, maybe even more, and I might be underestimating that. And they came along, and they didn't have an operation in Western Canada, and they don't acquire those smaller companies like the mom and pops that I talk about. It's just not worth the brain damage for them. And it's not material. It makes no impact on their results. But they will buy mid-sized players. And so they bought Vision. And Doug and Blair ran Western Canada for Securitas for a few years before figuring out that they were better entrepreneurs than they were employees, and they decided to exit. And then once their non-competes expired, they got back into the business. And that's where SRG came from and built up to the point where we acquired it here with the Pubco. And so would we sell? Sure, for the right offer. But I'm not sure that's an around the corner kind of thing. Certainly we look at our stock and we see how undervalued we are. One of those charts in the presentation was about how more than 40% of our market cap is in cash, and that number is even higher today than it was when that was published. And so, we're not trying to sell anytime soon at the right valuation. We're always willing to listen, but I think there's an opportunity here to grow a significant sized publicly traded security company in Canada through this consolidation and growth strategy. And once we get to more of a critical mass, maybe that would be something we'd look at more seriously, but certainly not in the near term.
I mean, it's always nice when you can go and say management has done it before and they're just kind of putting the band back together and going back on the road. So yeah, good to know. From an investor standpoint, so from sort of in my seat here, what sort of metrics or catalysts should investors like me be watching to know that you're executing on your business plan?
Yeah, I'd say the primary one, and the thing we really measure everything by regarding the security business, is adjusted EBITDA. Are we growing it, and are we doing it on a per share basis? So that's our, if we had one KPI, that's our KPI. Of course, revenue growth plays into that, but if we just we won't just grow at any cost. It needs to generate margin and be additive to the bottom line. The other thing, because we're concluding this pivot from one industry to another to watch, and that's why I include some slides in the deck on it, is the rapid shrinkage of our legacy business. It historically has been pretty noisy in our financials, and actually back when we were just an ag company, our financials were almost not understandable because of IFRS derivative accounting that was everywhere. The security business is very simple. I mean, you sell a guard's time for, I don't know, $25 an hour, and you pay them 18, and that $7 is your margin, and you do enough of that to cover your overhead at the administrative office, and what's left is your bottom line. And so there's no derivative accounting, there's no fancy stuff. It's really quite easy to get your head around, and I've just noticed a tremendous difference in that, even just dealing with bankers and the investment community since even just since this last quarter that we reported. We went to a new format of statements that really is about being a security company and not a lot of that legacy noise. So, but that would be a thing I would watch. What assets are still tied up in the legacy business, and how quickly is that coming down? So, I mean, that's the other side of that accounting entry is really cash. So, how quickly are we converting that to cash? And how much dry powder does that give us for future deals?
Gotcha. And we're sort of at the end here. We always like to give you guys an opportunity to give a parting message or a key takeaway. One solid thing or a couple of solid things to really sort of enforce what the business is all about. What would you like to say to our listeners?
Well, I would say key points are long-standing experience in this industry. So founders who've been in the industry since '88, built and sold in this sector and in other sectors before. So been there, done that, willing to do it again, and then I can't really underemphasize our balance sheet. Super strong balance sheet, aversion to debt, and we're really out to create a stable, predictable business here with a gradually up to the right slope to revenue and adjusted EBITDA. And with this transaction, once we complete the Logix transaction, our dividend payout ratio will drop. I think it's sub 30%, relative to adjusted EBITDA, and so everything just. I think it ultimately, and I said it once, I'll say it again, boring, but I think boring is good in this crazy volatile market. We're not going to be, we're not a tech play. I mean, we do cyber but we don't have software. We don't have anything proprietary. We're a service business, and we're going to grow. We're going to provide good service to our clients and good service to our investors. We pride ourselves on good IR. We've won some awards for it in the past, and we return everybody's calls and are happy to talk about our business to anybody who calls, from a 100 share owner to a 1 million share owner. And so at the end of the day, we're going to focus on running a good business. We're going to gradually get the magic of compounding working in our favor with more revenue, more bottom line, and getting out of the legacy business and just growing. And I think over time, when the compound effect of growing your top line at 5% a year and your bottom line at 10% a year and gradually increasing your dividend, usually works out to be a pretty good story, especially if you're starting at a good entry point. And today looks like a fabulous entry point, trading below book value and trading well below, although that's not really a relevant metric for a security company, but because so much of our balance sheet is cash or light cash, it is pretty relevant today. Yeah. So you're basically buying a share of our bank account and going forward with us as operators in the security business.
You've said a lot of words that are very comforting: boring, consistent, security, cash. I mean, things that a lot of people are looking for in this day and age, especially with the volatility in the markets. Brad, listen, I want to thank you for joining us today. Today we've been speaking to Brad Farquhar of SSC Security Services, symbol is SCCU on the Venture Exchange. We look forward to catching up with you in the near future, Brad.
You bet. Well, thanks very much. I appreciate the opportunity, and thanks to the viewers for logging in or watching this later. Feel free to call. My number's on the screen, and that's straight to my phone. There's no gatekeepers around here. Assistants cost too much, so we do all our own work.
Love it. Straight to the horse's mouth. That's
Yeah.
what we like. Perfect. Thanks so much, Brad.
All right. Thanks. Bye.
Bye.